Hey everybody, it's Mike from Orderflows, and today I want to go through a couple of actually about four questions that I got on a video that I posted the other day about one of the trade setups that I like to take. It's basically the exhaustion print at the high, and this was the chart from what day was this? The 13th, right? I was talking about this one lot that traded up here at the high of the day, on the retest going into the high of the day, which is your resistance, and the market's selling off from it. Okay, and there were some interesting conversations in the comments section. So I just want to go over some of them because they're very relevant, and I want to clarify some things just so you guys could get a better understanding of what I'm trying to tell you, so you don't get it confused with some stuff. So let me just go through the couple of the questions first, the simpler ones. Michael, I like your name. Wrote a couple of questions. Do I prefer trading bonds over E-minis and NQ? Says he's trying to transition from ES to bonds as they seem a bit more predictable. Yeah, I prefer them. I prefer interest rates definitely over the equities. I find the moves truer, and you don't get sort of this excess volatility that you see in the equities, right? The equities can have very big movements that you just don't necessarily see in the bonds. It's a different type of market. Equities are cash settled. The type of participants is completely different. Whereas, the bond market isn't, involving a lot of retail traders. I don't want to say hot money, but I just find the moves, a bit truer in the order flow. And, just for me personally, it's a bit easier to read because it's very strong liquidity. It's easy to get in and out of, when equities are moving very fast, the order book really thins out. But at least in, the interest rates, you do have size there. So, you're not giving up, extra ticks trying to get in and out of a position. So, if you're trying to make the switch from equities into interest rates, a great contract to take a look at, to start to sort of get your feet wet, is the 5 years, right? The ZF. Now, there are micro contracts on the interest rates, but those things barely trade. It's not worth the effort to look at them. The 5 years is a great contract. I think I got a 5-year chart here. I could just pull up really quick. This is my 10-year. ZF is the symbol on the fives. And again, there's nice volume. Now, the difference between the 5 years and, the bonds is 5 years trades in quarter ticks, right? One full tick. So from 108.29 to 108.30 is actually 4 ticks. In the bonds, it would just move from 29 to 30. And that makes each tick worth like $7.81. So like the full tick would be 31.25. You divide that by 4. Yeah, it's 781.25. $7.81 per tick. And again, if you're thinking about making that move over, it's a good contract to sort of get used to trading that market, because again, bonds generally move slower than the equity markets, but there are times where we're in a very interest rate sensitive market right now, where everyone's always talking, what's the Fed going to do? What's the Fed going to do? What's the Fed going to do? With inflation at these levels, so there is some extra volatility at times, like around a Fed meeting, obviously, or around an important number, and non-farm payrolls, CPI, obviously. I kind of miss the days when CPI was just another number that would come out. But, sort of to answer your question, why I prefer trading bonds over ES is, I just find the order flow a bit easier to read for me, right? And that is due to, sort of this, I'll say excess volatility, but the more volatility that you see in the equity markets than you see in the interest rate markets generally. But Michael also asked another question. Why would you wait for the candle to close? Do candles or their time frame actually matter when they close? Well, it's a reference point, okay? Because, when you're trading a time-based chart, okay, time-based charts, obviously different than a volume-based chart, tick-based chart, or range-based chart, right? Range-based charts are formed when price is moving, right? So obviously from the open to close, we're generally going higher. Now on a time-based chart, a 5-minute chart, after 5 minutes, boom, it just automatically starts a new bar. And the thing that I keep in mind, right, with time-based charts is, sometimes the chart just ends, right at the minute marker or whatever, time period you're looking at. But my reference is from the open of that bar. Just as you would look at, you look at the market, you turn on CNBC, oh, Dow is down 50 points today. Okay, well, what's the reference? It's from the day's, the previous day's close, which, generally is the open, but you got to have a reference that you're measuring it from, right? Where are you determining, is this market going higher or is it going lower, right? Now, if you're trading let's get back to the chart here. Okay, so this is, a 5-minute chart. Okay, so I know that this big green candle here, yeah, the momentum is going higher, right? Market is going up. Obviously, it's a green candle. I mean, green means market's going up. But from, where it opened, I know that we are moving higher, right? So you got to have some sort of reference. That's why I wait for the bars to close, because, if you watch a bar, there's times where the market, looks bullish very early on, but then things change, especially if you're on a longer time frame. Your 15-minute chart, 30-minute chart, things could look bullish the first 5 minutes, and you're thinking, oh, I got, it's going up, I got to get long. You get long, but the whole bar hasn't played out, right? And then, 3 minutes before the bar closes, some very bearish information comes out, and the bar closes down, and it's a red bar, and you're like thinking, why did I take that trade? So yes, for me, candle closes, bar closes are important, right? There's a reason why, a high and a low is made over that time period. And again, I like to reference where the market closed relative to where it opens, because generally a bar is going to open at the same price the previous bar closed, more or less. Maybe it might be a tick above or a tick below, depending on where the bid offer was when the market closed and if the market was moving. But generally, it's going to be, right around the same level. The open of the current bar is going to be right around the same price as the close of the previous bar. So yeah, for me, in my analysis, yes, they matter, right? And I know in my trading, I've tried that. I've tried to get long as soon as something bullish comes in the order flow, but that it could just be a big order hitting the market. And, I'm getting excited over one order hitting the market. I want to see, continual buy orders coming in to sort of support my thesis, if you will, on why I'm getting long. Because just because I think, I should get long, if nobody else in the world thinks, this market's going up, it's not going to go up. Even if I could think all I want and then hope and pray, but that's not what's going to get the market to go up. It's the other buyers. I also want to see, the continued buying going up. Okay, so I hope that answers your question. And again, there was a nice little heated debate, nice little thread going on this chart here. Let me just pull it up. This was the 5-year chart. Where are we? ZN. Okay, because I was talking about this single print here, this one lot. Okay, so the market, it had shot up on the number, it made a new high by a tick, sort of came off a little bit, came back up, traded one contract up here. I said that's the last buyer that's buying, and then the market sold off. Okay, so Yavno had, he started an interesting thread, and there's a lot of people jumped in to sort of explain it out. But I want to, rather than me type it out, I'd rather explain it out, because he says, at first, he was talking about this bar at 810. It retested the 755 high. Okay, then it went higher. So let's take a look at that bar here. So this was the 755 bar. It tested it here at 810, and then went higher. It didn't sell off. I mean, you have no sort of asking, why did this one go higher as opposed to this one selling off? Well, again, that sort of goes back to that previous question on waiting for the bar to close, right? Why I wait for the bar to close. this bar is still showing, even though it's kind of a small bullish candle, it's still bullish, okay, for one, right? It's still closing green. So I know the momentum is still to the upside. So there still could be some buying. This bar here closed down, right? We're closing on our low. Even though this one is off of the high, it's still, the momentum is still to the upside. So there's still some buying. Now, had this next bar, this bar at 815, started trading lower, honestly, I wouldn't take it. I don't like taking bearish signals off green candles, right? If I'm looking for a bearish signal, it's going to be off of a red candle. So, that's the reason, right? And it goes back to sort of the earlier question from Michael. Why is, the bar close for me important? Because it's still telling me, sort of the momentum that's in the market. The market is still going up, right? Green candle, two green candles. I'm not ready to fade it yet. Yeah, I want to see the price action, right? Everyone talks about price action. Price action is still going higher. Okay, even though it just traded one contract up there, it did come off. Okay, fine. But it's not coming off enough for me to be bearish, right? It's still holding above, the open or, the close of the previous bar. So it's still technically in an uptrend. If it were to close down, then yeah, I would have kind of the same thought that I have up here. Now this obviously is a resistance area, right? It's your high of the day. Right? People say, well, how do you know that's resistance? Well, it's the high of the day. You've already made that high. There were sellers. We hit it up there and the market came off, right? That's what happens at resistance. Markets sell off from resistance. Now we're testing it and we don't go higher. This is not necessarily a resistance area. I mean, it is I guess you could call it a swing high if that, but that's even a stretch because we're still inside of that big bar from, when the number came out, right? In here at 730 and we even poked higher. So it's still, inside of the range that you've been trading. So I think calling it a swing high would be a bit of a stretch. But again, what's going on in the price action of the candle? Well, it's still bullish, right? It's still got that bullish move in it, right? It's still a green candle. So, I hope that answers that first part because that sort of goes into the second part that I'm going to get into. Actually, this first question I answered came in first before this one. It says at 820, 825, 830, there were no sellers at the bottom. It showed zero, yet the market went down. All right, so let's take a look back at the chart here. So, where was it here? Here, 820, 825, 830. Okay, and the market went down. Now, this is different because these are already red candles, right? If I'm looking for price exhaustion, I'm not looking for exhaustion at the bottom of a red candle. Market's already moving down. I'm looking at the top of the red candle. That's where you're going to find the exhaustion, right? Because a move going up is going to get exhausted eventually, right? The people are going to lose interest in buying. They're going to have no more money left to buy with, okay? Now, when it's going down, the zero, this is what normal order flow looks like. Now, in order flow analysis, there's a term. I didn't invent this term. This term was invented by others, in the early 2000s, called unfinished auction. This is what a finished auction looks like. Now, we don't have to draw a zero on there, but what it would look like, what it really should look like, is just at 7.5, this 24 against this 289. So 7.5, 8 is what the market was when the bar closed. Okay, down here, this is a unfinished auction at 2.5, and there was no volume here at 02. So it was actually at this bar, at the bottom of this bar, was actually 2 bid at 2.5. The reason why there's no zero printed down there is because you would have to, for the zero to print, you'd have to go a little bit lower on the offer side. There's a zero here because this market was trading 7.5 at 8, right? I hope you can understand that. This is the bottom of the bar, right? There's no volume that traded below here, just as there's no volume that traded below here. If this was what is called a finished auction, there would be a zero here. Okay, now there's a whole way to trade unfinished auctions, or as some people refer to them as unfinished business, right? When you have unfinished business, often Traders are looking for the market to come back and make a finished auction where there is that zero at the bottom of the bar, okay, or the top of a bar like here, right? The 642 and the 850. This is an unfinished auction up here. So even though there's the zero there, it's there because the software is telling it to put a field in there, right? Put a value, rather, not a field. Put a value in that field. It could easily just be 24 against 289 with nothing here, okay? So just because you see that zero on the bottom of the offer side in a red candle, that isn't a sign of exhaustion, right? For red candles, you're looking for exhaustion at the top of the bars, just as on green candles, you're looking for exhaustion on the bottom of bars. So I hope that clears that up a bit. It's just one of those things where at the tops of green candles, right, generally you're going to have the zero on the bid offer side at the top, right, because this market went up and it was 7.5 at 8. Okay, and there's no volume here. If there was one contract traded at 8, then you'd see a 1 here, right? And that means that it was 8. It actually was 8 bid. This market never went 8 bid. That's why there's a 0 here. Okay, just as here, and here, and here, it never went offered at 7.5. It never went offered at 7. It never went offered at 6.5 in this bar. Obviously, the next bars we did, but in this bar, it never went offered at 7. Never went offered at 6.5. That's why there's a 0 there. Okay, and there's no volume in there. Obviously, 0 is just means no volume. So that's not necessarily a sign that the market should go lower, right? Because the market's already moving lower, but it just hasn't gone offered there yet. Okay, so I hope that clears that up for you, Gav. No, I mean I do appreciate your questions, and your comments. There was a comment from Sandstorm Feline. I appreciate the amount of information you put out. It's a nice change of pace to see you including crypto markets. Yeah, crypto markets are interesting in terms of order flow because it's a bit different than, say, futures, because with futures, there's a fixed contract size, whereas crypto, you can trade pretty much any amount. You can buy $5 worth of Bitcoin. I mean, you can't buy $5 worth of a E-mini contract. You got to put down margin and all that. But with crypto, you could buy pretty much any amount. And at first it made it a little bit difficult till we sort of figured out how to price it in Satoshis so it'll show up on the chart right, and sort of aggregate the volume and sort of work our way around it. But it does, there are things in crypto markets that you can use order flow with to look at. And to be honest, I do watch crypto. I don't trade crypto at all. For me, it's not, when you think of term trading crypto, really, there's not a lot of people that are active in the way they're active in, say, futures or stocks. A lot of in and out, day trading. But you can watch crypto on a 15-minute chart, a 30-minute chart, for sort of longer term views, or hold buy and hold for a few days. It's nice to see how it reacts at swing highs and swing lows, or if you see big supportive volume coming in or resistance coming in, with heavy volume on the offer, or if a market is breaking. There are nice things. I'll try to get some more crypto videos up. Again, the thing is, I use NinjaTrader. They do have, you could download NinjaTrader. They connect to the Coinbase data feed, actually, and it's free of charge. I do know that there are other softwares out there. I think ExoCharts was one that has a footprint, and but that's a paid one. And there's a few other footprints out there, but I used to watch ETH, but not anymore. I focus mainly on Bitcoin. I do watch Doge. People probably laugh at me for saying that, but it's actually a nice contract in terms of how it moves with the order flow. So I'll try and get some more videos on crypto up. It's a fast. It's a vehicle for trading. right? And whether it's crypto or E-mini S&Ps or Tesla stock, I'm always fascinated on seeing what parts of order flow matter more in different markets. So thanks everyone. Be sure to like and subscribe to the channel, and keep those comments coming. I won't necessarily make a video on all of them, but the ones that I think are interesting and are relevant, I'd most definitely try to, because it's the thing with order flow is it's information, and you really behooves you to use it. Okay, so again, thanks everyone, and I'll catch you guys on the next video. Bye bye.